Let's wait for Katerina to give us the starting signal. Thank you very much, Katerina. Welcome, everybody. Welcome to my webinar, broadcasting live from Mexico City. Today is Friday, March 24th, 2017. This is me, Alberto Alvarado. If you haven't subscribed to my YouTube channel, this is the way you do it. You go to YouTube, you type in the search box iiivb Training Room channel. This shows up. You click subscribe. I wanted to update this channel yesterday. It was not possible for me, but for sure this weekend I will update it, so stay tuned there. If you want to follow me in the Google Plus network, you look, you type iiivb Training Room, you follow me there, or you just bookmark my Google Plus account. You just Google this, Google Plus, iiivb Training Room. In the results of the search, you look for the one where my picture shows, and you bookmark it. There is where the updates that maybe don't merit a video, just some lines, I will update them there. Okay, so today is going to be a slow day. I don't know if we're going to make it 1 hour. It's been a very tough week for me. It's been a good week for a very tough one. So there are not a lot of things to talk about. Well, yes, there are a lot of things, but maybe same things that I've been saying during the latest webinars. So maybe reviewing them one over and over again could be like some kind of boring. We will start with my post on Friday about the price range boxes in dollar-yen just after FOMC. This is the FOMC sell-off. I was explaining yesterday that this point in time, this time cliff, price cliff, was here because of a reason. And yes, when the market got here and was not above this level, they just simply decided to sell it just to the 111. It's been making a huge support here, regardless of what the mass media is very eager to sell you, because some moments ago I was tuning in Bloomberg, and what they were saying is that this is the daily chart in dollar-yen, by the way. Sorry. We have a ruling descending triangle, a very high quality one, that comes from last year, from week 48 of last year, more or less November, I guess, or something. So we had this movement. Then we had this attempt of breakout that it actually worked fine. This is a FOMC sell-off. As you can see, the price got below this 14 period moving average, and from that time on, the price just started selling off. But we need to look at the structure of the selling off, because it's not the same every selling off. When you have, for example, this Chinese pattern being broken to the upside, a fake breakout, then getting inside the Chinese pattern and then trying to break it to the downside, it's like, well, if it didn't make it here, the most likely things that it won't make it here. And we have these very good levels of support. So in Bloomberg, what it was said some minutes ago is that now the risks for the dollar-yen are to the downside. Well, everybody has the right to have their own opinions on something. That's a right that we have as traders. The thing is that at the end, we have a profit, no matter if maybe we started with the wrong foot. And assuming things incorrectly, a trader, the job of a trader is to know how to maneuver and to manage a trade, to reduce the losses or even neutralize them and to convert them into profits. Of course, this is difficult, but when you have enough time trading, that is a skill that is developed, or that you need to develop, and you start developing even if you don't realize it. at some moment it becomes clear that a lot of the stuff that you learned during your trading career, your trading learning curve, that maybe things that you really didn't know where to put them because maybe you said this, what this will be useful for, etc. At the end, when you get to a point, you realize the usage and and how all those things that you learned during your learning trading career is useful for. Okay, we have a comment here. FX Lordai says that's a false breakout on the higher high, so that bearish trend line must be adjusted to that high and still considering trading below it, right? Well, this is a computerized drawn pattern by the chartist widget in Dukascopy J4X platform. I tend to trust this pretty much 100% of the times because I use them as references. Yes, we should maybe update it here, but for some reason the computer hasn't done it. So I just allow the heavy lifting of the drawing of these chartist patterns to let them to computers, at least these kind of computers, because they just not only rely on higher highs, but on the proportion of these blue lines. So mathematically they are measuring it, and until the computer detects that maybe this swing is significant to maybe draw a complete different pattern, that's usually what this computer does, that when you don't have an update, when this happens overall on the daily chart, that means that the computer, the most likely thing is that maybe in some days it will just simply delete this pattern because it's already useless. It's a fake breakout to the upside, it's a fake breakout to the downside, so this is only reference. Why I use it? Because it's a daily chart, and this has been helpful to, for example, the first trades during the months on long on yen were precisely based on these breakouts, and it started moving up. And at some moment when we had this initial post-FOMC sell-off in the minor time frames, we realized that actually this trend line was respected. So, and even here, this trend line is respected, this trend line is respected. So yeah, it's been useful. Maybe it's not absolute. Here it says, oh, like a zigzag indicator, thanks, retaining indicator based on the price action. Well, yeah, I don't know. It is said that theoretically, when you draw triangles and that, there must be a proportion. But when you go to classic technical analysis books on chartist patterns, they are not really outspoken about that. But there was a need to include mathematical calculations to allow computers to really draw these kind of things accurately. So maybe let's call it a secret that they kept for a long time, the chartist, the people that tend to draw accurate chartist formations, that maybe they use these proportions but without telling out to the public because, well, it was their edge. For computers, there was no other way to make them draw this accurately, because if not, they could be drawing it randomly and every time and in every time frame, thousands of chartist patterns a moment. So what I believe, again, is that this chartist pattern will be deleted next week. Actually, we have, if we look here, this is the widget, we have a descending triangle 77%. But actually, we have other, and actually, yes, actually, look at this. This was just updated some minutes ago because I didn't have this some minutes ago. Look at this. Okay, no, sorry. No, I'm wrong. We just have a 74% pseudo double bottom. This is the same, dollar yen, 1 day. But if you realize this is a descending triangle 77%, that's why I use it as in quality higher. But we have just below that a double bottom 74. So this looks much more valid, right? Even though we have this here, because this could easily become a triple bottom because of this. But of course, the mathematical proportions maybe won't allow it. But the thing is that this widget is really useful for trading, and it's you can acquire it in the JForex platform by Dukascopy, and it's a very useful tool because you have another kind of technical indicator that is most likely like not lagging indicator but leading indicator because it's a chart is form. But of course, this again, there is no absolute indicator. There is no absolute leading indicator. Maybe the only one is the fundamentals indicators and the very long-term ones, like the ones that I believe that are playing in dollar yen, by the way, because I've been explaining during other webinars that even though we have this sell-off, that here in the double top configuration, well, the market just retested this high and just started selling off this, could give us another explanation why the market decided to start to maybe taking some profit here. Then it increased after FOMC minutes, and then we had spring entering. Then the sell-off started, and we're heading here just at this low. But well, this all is because of something. Some minutes ago, I was watching Bloomberg, and they were actually saying that because the market was just here, the risks were to the downside. And of course, I cannot discuss, and nobody can discuss others' assumptions and speculations on the markets because are speculations. But the thing is that Bloomberg does this every time. When something is starting to breaking down, for example, why they didn't say that when they started breaking up here, that is this pattern. They didn't start saying this is a buying opportunity, this is a buying opportunity. Why they didn't? Why they are just saying it just at this moment where it's the precise, beautiful entry price level for long-term investors. I've been saying that this conflict of interest thing that you need to always have in mind when you are reading any kind of news, fundamental, financial, geopolitics, and this thing about Donald Trump, elections, Russia, etc. There's a conflict of interest. The mass media is not independent. They answer to economic interests, of course. There's a huge mass of mass media, for example, in the United States that are ruled by people of the Jewish culture. So, of course, what you can expect is that if there is something not good to say about maybe Israel, you won't be maybe seeing that aggressive comments against them in this kind of news. You have, on the other hand, when you have maybe some Arabic mass media, it's way more common that you see very outspoken and aggressive comments against Israel from this kind of news. So when you're in front of the news, you need to firstly know where is the conflict of interest. And Bloomberg and the biggest of the mass media of the financial channels, it's very difficult to know what's their conflict of interest, but it won't be surprising that they get this wrong again, that when something is breaking this and calling it to a risk to the downside, that is not true. I mean, and I can say it plain and simple. Yes, this sell-off started maybe moving the sentiment a little bit to the downside, start making, causing some hesitations, yes. But we're still testing this bottom. I mean, when you realize and when you track the markets for long enough, you realize that a trend line is not a line, it's a zone. This is a support zone, not a support line. And this zone could extend to here, or to here, or to here, it depends. When it's a daily chart and when you have a straight flat line that is working as a support, you can expect that this is not the pip line. This is a region that could go even to the psychological 110. I was saying yesterday that yes, I still hold that this is a buying zone for kind of investor type of people or hedge fund that are looking for the next months that maybe this will get to the 120 or even further in the next year, next 2 years. Why? Because again, and I will repeat it again, why I chose dollar yen, because among all pairs, among all crosses, is the only one that is clear as water, the direction. You have a flamboyant, a very outperforming American economy against a very weak Japanese economy. When you put that together, it's a no-brainer. That doesn't mean that this will go straight up for the next decade. No. Of course, these are natural moves. The swings to the downside are just opportunities to buy, the same way the swings to the upside are opportunities to sell. It all depends on the context. But I chose this because differently from cable, that we're still having Brexit turbulences, differently from euro-dollar, that we have some risk, that today, again, Bloomberg was saying that Le Pen is not precisely that far from really getting into the presidential career and maybe getting into the presidency. So all those risks that could be factored in euro or in pound or in other currencies are not in the dollar yen, because you don't have something inside that could change the overall outlook of the current price action. I mean, you don't have a potential breakup of the traditional institutions in Japan. The thing that could happen in Europe, if for some reason Le Pen gets the presidency and makes this referendum to stay or leave the EU, the most likely thing is that the leave vote will win, because all the ones that voted for her will vote for leaving. Well, that's like a natural thing. So that could have the potential of breaking the complete European Union. The Brexit thing is already digested, but there's still some volatility to see that maybe could mean buying opportunities for pound, at least in my opinion. But we still can face those outside economic fundamental aspects that you need to watch when you trade those things. Dollar yen is not that case. So Bloomberg saying that easily just because of a technical thing, that the risks are to the downside, for me it's irresponsible. It is supposed that in the United States you cannot give financial advice, and in other countries, if you are not authorized and you have a license to do that, advice. But these people just say this kind of stuff that openly and irresponsibly because they're not giving the complete picture. They're not giving why, for example, they don't talk about yesterday, and I'm going to pull that chart. That we were analyzing yesterday, the 1 hour chart. We have some comments. Exactly, RacerX, David, good morning, welcome. Yes, they are answering to marketing. They have their own bosses, or the ones that pay publicity, or even governments. They have an agenda. Which agenda? Who knows? What interest? Well, it depends. Maybe today is pro-United States, and then it's not that pro-United States, and that's it. So yeah, but they have their agenda. FX Lord Eyes, it's valid just for the retail traders, the small fishes. Ad revenue, exactly, David. Yeah, it's well, I don't know exactly what you mean, FX Lord Eyes. It's valid just for the retail traders. If these comments by Bloomberg, or I don't know exactly what you mean. But in the meanwhile, if you mind to explain, here is the hourly chart. License for financial advisor. Okay, that it's relevant only for retail traders. So if I am advising big institutions, I don't need to have a license? Or what? I am confused. Well, this is FOMC sell-off, and I've been tracking how this volume just started picking up after this breakout. We explained that this breakout corresponds I need two monitors. I don't find it. Here it is. Okay. Here it is, okay? We drew them on Friday. Drew this on Friday, okay? So when we started having this sell-off, the volumes, as you can see, started picking up visibly. Here, higher, higher, higher. The lower it got, the higher it got. And that corresponds to these levels. So what this was telling me is that this was, a real sell-off, but there were a lot of people buying here. And of course, a lot of people selling, but the volume was picking up. This goes in congruence with my idea that when I posted this, I said that depending on the price action, how it reacted to these price boxes, that could lead us to a deep buy mode in the future. Actually, that's what is happening, and this is a confirmation, at least for me. I was expecting that this was not going to be respected and the price to hover here by this time. The risks were that if the price was hovering in this zone while this cliff was reached, the risks were to the downside, and actually it happened. But in the other hand, since I am considering this as a fundamental bias trade, that is a no-brainer trade. I mean, you could have positions not in profit for a long time, but fundamentally this is poised to the upside, period, because of the fundamentals. I mean, tomorrow you won't have a surprise by Japan that could make you rethink this kind of stuff. The only thing that maybe could make you rethink is that Donald Trump started wanting to fix a machine that is not broken, trying to move and to fix the American economy when it is not broken, and trying to experiment with it. But apparently what time is telling us is that that won't happen. It's the only thing that could change this. So if things continue the way they are, the most likely is that we will continue having at least 6 or 9 more months of good American data against the traditional last decade very questionable economic result by Japan. So this is a no-brainer to the upside, and this volume picking up while this had a sell-off, at least for me, is a confirmation of my overall bias. Okay, so this is the hourly chart, and of course Bloomberg is not explaining you this. Why in the hell then this sold off and volume started picking up? Just at a daily very important support region. Because if they say so, that the risks are to the downside thing are ruled out. I mean, that doesn't mean that they are not true, but they would simply neutralize what they are selling. They need to sell something. They need to create hype. They need to make people believe that they are necessary to find a direction of something. So if they put all these things together, maybe they wouldn't call this as a fundamental long-term buy opportunity, because this could be hovering for days or weeks, these levels. So it's not precisely that marketeerable trading setup, because it will maybe be hovering here for days. It is way more attractive to marketeer a continuation of a direct sell-off. So the thing is that the only way that you can approach to the mass media and to acquire information is to simply put always the inverse sign of all the things that they say, and then make your own opinion. Meaning, every time that the mass media says the risks are to the downside, yeah, okay, checked, you put in a list. But then you find all the other reasons why that could mean a buying opportunity. At the end, it's irrelevant, because maybe it could start hovering here, and maybe it could continue selling off, or it could continue selling off to the 110 and then spike to the upside, and then who has reason? The one that is bullish, it depends on your time projections of your interest, your account size, etc. If you are over leveraged here and you buy, of course, if this sells off to the 110, maybe you will have a margin call. So you were wrong. Even if after the 110 this spikes to the 115, you were wrong. What was wrong with you? Your leverage. If you have a responsible money management and you are bull and you are bullish here, this could continue to the psychological 10, stay here for some days and then shoot up. Then were you right or wrong? Well, if you had shorted here, you could have profited here, but it depends on your style and your mindset. One of the beautiful things of the Forex market is that you actually have here tons of people, tons of volumes having interest of buying or selling no matter the condition and no matter what the time. Because it's so liquid and so big, and you have responsibilities to pay. You have bills to pay. The Japanese enterprises pay taxes, for example, in Japanese yen, not in American dollars. If they have to make a conversion, they will do it no matter what. Of course, there's a much more sophisticated thing like financial engineering. You can hedge with options. You have a lot of stuff. But the thing is, you will always find a buyer and you will always find a seller because it's so diversified, the interest of holding yen or not holding them, that it's pretty much impossible that at some point you won't find somebody that is interested in taking the counterpart of that. So the only way to really know if you are right or wrong in trading is that you can have a profit, and when you put the statistical data of what it took you, the drawdown, the open positions, the stop losses used, the drawdown that you incurred, etc., that it's acceptable and you have a profit, then you were a successful trader. Even if this initially sold off. Why you should be interested in selling here? For example, I'm not interested in selling dollar and buying yen because I know that at some moment I can have a huge spike of 50 pips just because a hedge fund just decided to buy dollar and sell yen because they are foreseeing a potential opportunity for the next 3 months. But in the meanwhile, I'll short it here. It could spike here to stop me out, and then the market would come back again, maybe dip a little bit, and then move up again, and then do this again, and maybe in 3 months a spike here. You need to picture yourself a timing of what you can expect of a trade during some time span, and you adapt your trade in that direction. Meaning, if you were a super short-term short dollar yen trader, of course you could have profited a lot from this sell-off. Of course that is true. But if you're a even longer term dollar yen buyer, these are buying opportunities. You are not eager to sell them now or in 1 week because you're not over leveraged, for example. So they could buy here, they could buy here, they could continue buying here. I can tell you something, the price action in the 5, in the 1, and in the 1 in the 1 hour, 15 and 30 minute chart in dollar yen has been great. It has had swings of 10 pip to the upside and downside and upside and downside because there's a lot of buying interest here. This is exactly what happened here. Sorry, yes, it was here. The market during all this day was making lower low with that precise pattern. In the lower time frames, the lower it got, the higher the volume, and then spiked to the upside. This is the same pattern that we are seeing here. Now, the difference is it's a little bit lower, but it's not that, I mean, even somebody want to sell you the idea that this is a selling active opportunity, it's relative because we still have to break the psychological 110. So all this is a buying region. That doesn't mean that you will find selling opportunities. Maybe you could sell here and profit here. Tomorrow you could sell here and profit here, yes. But if you buy here, and if you buy here, and you buy here, and you wait long enough, maybe this could turn to be this way. So it depends on your interest. Here it says, we have a comment. FX Lord Eyes. Yes, media can have advices. Yes. They are, I don't know when the supposed authorities in these countries will really push them to stop doing that because they are misleading a lot of people. I mean, this is not new. This has happened for decades, but it just continues happening just because they don't use the word advice. They need to put all the information on the table and then let the people decide, but they are not putting all the information on the table. At least in that risk to the downside thing, they're not saying nothing but that. Why two boxes at the same level and not just one bigger? Overlapping those two? No. This is because this is the important thing, this time cliff. When I draw these boxes, of course, if I had drawn just a straight line, straight box, this thing wouldn't have happened. Or this, for example. You see the difference? If I had overlapped these two boxes, we wouldn't have this time window where a potential cliff to the downside was open if the price was not hovering here. You see? I had this time this price box here because for me at this date, 2021 of March, if the price was not hovering above, being supported by this line and by this line, if the market that was here, this time cliff would lead to a sell-off, a potential sell-off. It's the same here. Here, I was expecting that at some moment, if the price was hovering here at this moment, the risks were to the upside. So it's not only price, it's how these price range boxes interact among themselves and with time, plus the actual price action, what it will end up being in a movement. So that is why you can see this, the moment this box stopped being active, the sell-off started. This is why, because these boxes are I share them because they mean a price time synchronization tool. You more or less could have an idea when something is expected to happen if something else didn't happen. If the other something else didn't happen, the price hovering here, the risks here were that this could start a sell-off. I was not expecting it to start this low. I need to be sure of that. Maybe I was expecting the price to be here and then start selling off. But well, the thing is that, yeah, the timing was right. That is why I use these two boxes, and they are not usually at the same, if you watch them, the same exact thickness, etc. So, well, this I have explained a little bit more that in other webinars. Maybe you would want to review them in the YouTube Dukascopy channel. I have reviewed that interactions in a much more deeper way. But bottom line is that these are time cliffs, and they are here because I consider that at this moment this range box is temporarily not relevant, at least to support, because the idea of this was to support or to be a support region. It could turn out to be a resistance region, what it actually happened. And exactly when it started being a resistant region is where this support role was ruled out. And this, well, this is the explanation that I find. So here it says, raise your access, I hear you. FX Lord Eyes, yeah, so one trader could go short and one buy. And both can win or lose. It all depends on their analysis, money management, and period of their trade exactly. Position traders use Japanese yen, owning it for long-term portfolio. You mean buying yen or selling yen? Shorting them. I assume that you say buying yen. Rokaslu, good morning. Or Toyota and Subaru need to repatriate yen to bulk. Exactly. Exactly. So we have tons of interest. Usually these big enterprises do that in advance using forwards or hedging or using options or something. They're maybe not actually buying those amounts in the open market. They need to make all the budget to square, so they use derivative to make square a budget. And not that maybe they said, we needed to do this, but it ended up being more expensive. No, they need at least to play a budget and to make it square for some months. But yeah, at some moment somebody will need to buy those yen or to sell them, and it will happen at the best next opportunity in the forex markets. We're really not knowing if this sell-off was because of what. If it was really because of this latest days sell-off in the stock market, I stopped following that yesterday. I don't know how the stock markets did yesterday, etc. We explained that yesterday also. So it's a very complicated thing. In the forex market, something that is really hard to explain because everything can be explained in both ways: bearish, bullish, active, passive. So it's relative. So we only have like intuition, like this timing tool that could more or less lead us to know when we can expect. Here, as you can see, price is irrelevant. It's way more important when it could happen. Because if somebody, okay, I was saying yesterday, if somebody decided to believe that this box was, since the price was hovering in this region and not this, at this moment where this time cliff could lead to a sell-off, and decided to, you know what, let's short here and wait and use a stop loss maybe here or here. Look the position. It would have been a great sell, short position. But it could have only sold off here and maybe spiked up and maybe consolidate here, etc. It depends. You need to start. We really don't know what is going to happen. The best that we can know is have an idea when it's the most likely possibility in time that it could happen something relevant regardless of the direction. But when you have a timing tool, at least you know that maybe you are looking for something potentially big to happen. And maybe you start watching differently the markets because you actually know that something big could happen that day or that hour, those hours. And maybe if you see potential bearish opportunities in this zone, you decide to short. Well, here is the result. Here it says FX Florida is through hedging their export contracts actually market arbitrage. Yes, they need to do that. But at some moment, there are institutions, I've been saying, hedge funds, institutional banks, all those ones are the ones taking the risks that these guys want to get rid of. That's why they buy derivatives. But the ones selling derivatives are the institutional banks. Those are the ones taking the risks, and those are the ones moving money actively here. Because those are the ones that need to start adjusting their portfolios, and when it's related to currency, they need to take position to short things, to long things, and maybe in the contrary and completely fundamental approach, that maybe fundamentally this is long, but maybe this sell-off was caused by massive institutions just squaring their portfolios of risks that maybe they just took by derivatives, and for some reason they decided to sell because that was in their best interest, not because of something else. So this sell-off is when it means a very good buying long-term opportunity because it's not fundamentally driven. That is what I still believe. It's not fundamentally driven. It's very close to the psychological 110, but I wouldn't be. I will continue being bullish on dollar yen until 110 is convincingly broken. And I can tell you that could take a lot of time. And even the price getting to the 109, maybe retesting the 110, then again the 109.50, and then moving above the 110. So it's a process. Overall, when you have a fundamental bias, it's like imagine that you're driving these huge ships in the sea with loads of containers. Imagine that a fundamental trade is that, and imagine those containers full of whatever you want. And that little ship is moving to, let's say, from Europe to United States. If for some reason this ship needs to change direction 180 degrees, meaning switching from bullish to bearish, how long it would take to this ship that is fully loaded of containers, fully loaded of things, to move 180 degrees? It is not something that you just do in a snap, because you sank the ship. You sink the ship if you do that. It's a complete maneuver of long term that you start circumventing and doing, and to measure wind, and to measure the tides, etc., just to do that 180 degrees move. It could even take days to do that. Now imagine when we're talking about global money flows. Switching a fundamental thing could take years. Of course, there are exceptions. 2008 crisis, when all the bubbles burst, you have sudden switches of direction. That is why chaos appears, because that shouldn't be happening. You don't give time to the economy to adapt. But yes, it do happens. But when we have anomalies like bubbles, when you have something more or less stable, switching fundamental bias takes a long time, because you need to verify. When we start having 1 bad month, 2 bad month, 3 bad month of bad American data, you could start thinking that maybe longing dollar yen is not a good idea. But either shorting it, maybe it would become like a range bound thing. So here it says bucks to yen. Okay, it says David. No worries, my friend. FX Lord, so this is a true Arcanaut game. Yes, I liked a lot of when you said that, because yes, it reminded me my teenage years that I loved that game. And yes, this is this is how I understand it. It's not this simple, of course. Overall, because when you try to read this is 1 hour chart, and you go to the 1 minute chart and try to apply these boxes, it's like a complete confusion. But yeah, it's an interaction between time, price, how these time, price range boxes interact among themselves, open timing cliffs that are priced potentially, that they have a potential price movement, like in here or like in here. So yeah, if it was not hard enough to trade the forex markets, you need to be able to combine, to make this interact among themselves, to see how price action interact with each other, and then being aware of the timing, being aware of the stock markets, etc. Okay. Here it says, FX Lord I selling dollar in order to own dollar yen. This is what FX market was created. Racer X, I have noticed that when the Nikkei does well, the yen is ready to go long again. Is filling with crappy video cards, for example. Well, it depends. If they come from China, maybe, but I don't think that if they come from Japan. Well, yeah, the forex market is like any market. It's like selling apples. People sometimes want apples, sometimes they want oranges. It's an exchange. Of course, this opens opportunities for people that are not precisely interested in eating apples or eating oranges. We are like playing the intermediary part. Like, okay, if I see some apples are going to be demanded in the future, I buy some apples, I expect the price to go up, and then I sell the apples, maybe to the ones that are really eating them. That is why there's a moral questioning of what the speculators do, because it says that they don't play any social role, a good social and constructive social role in society, just because they're speculating with price, generating no wealth. Well, that is relative, of course, because as long as you pay taxes, if you're a very successful trader, you pay a lot of taxes, and that is helping a lot of people. And the other, if you have money that you earn this way, and you spend in buying a house, buying a car, spending money, buying whatever, in supermarkets, etc., that is having a social role. Maybe not that hypocrite and traditional role that you need to create jobs in order to be socially acceptable, etc. But okay, the thing is that it is explained that maybe speculators are there to provide liquidity, because without them, maybe the markets would be choppier, and that is true. thanks to a lot of people that are trying to dissipate movements, you can have a lot of interest and you can have a lot of volume every single tick that can be taken out thanks to that. Because if only the real ones, let's say the end user of those apples were the only that could buy apples or sell apples, you would have a much more illiquid market that would move even more volatile, and at least in a less manageable way. At the beginning, this started if I'm not wrong, the Chicago Mercantile Exchange, the one that started managing futures of corn. That happened because before when there were no corn futures in the United States, actually the prices of corn were so volatile that the corn people, the ones that are in the harvesting the corn, they could run into a lot of risk just because they really have no idea what price they will be selling the crop, and that could actually ruin them. And the prices of corn were so precisely moving that fast because of the illiquidity. So it came, this futures market, so people could have the certainty of no matter what, how much they will be paid for their crop in the future. So they can plan, and they can grow, and they can ask for credit, for example, to buy tractors, to buy, etc., new technology. Thanks to this derivative, people had the chance to move the risk to other in exchange of their having certainty to grow their business. But then, when they decided to transfer the risk, the ones that were holding the risk now, were the ones that were selling those contracts, those futures, needed a way to hedge themselves. So the market started evolving in a natural way that, okay, I am holding this risk, let's find a way to maybe see if I can move the risk to other or to mitigate it. And this is like a natural movement. Ultimately, the ones that are taking the risks, their social role is that they are allowing others to simply get rid of the risk. That's your plain social role. And that is huge, because that gives certainty to a lot of people, a lot of families. So when you do that, you're actually making that social role. What's your role? You're acquiring risk of holding a position that is completely uncertain. Because most certainly that is a small part of somebody that decided to just getting rid of that risk and to have something for sure, for granted. So that's your social role. You're making a living of risk, allowing others to get rid of the risk, and you're assuming it. Of course, with risks come rewards and losses. So, I don't know, Karina, if we have somebody next, if you could please tell me. Yes, well, David, about your comment Nikkei and yen, well, at times, yes, these correlations happen, but they are not continuous. So at times, yes, buying yen or selling yen when Nikkei goes up, that could be extinct, that could end. So this is why correlations are something temporary. At times you will see the complete opposite. Yes, for FX floor dice, yes, but on the FX we won't own the apples or the oranges. So FX was created to be used as hedging for those that own the apples or oranges. Yes, exactly. Racer X, good point. FX Lord Ice contract for difference. And whether trading as hedging contracts for the agriculture business, yes, I agree. As insurance companies for the old ship transport goods over the season, so on. Yes, I agree. You can hedge loads if your loan is in a different currency than your earnings. Yes, that is what was called the carry trade, right? that it was like an unlimited possibility world just before the 2008 crisis, that apparently there was a free way to earn money, right? You just sold yen, sell yen, and buy dollars. And the difference between the interest between holding dollars and selling yen were so big, overall the pound yen. So it was like theoretically possible to win money endless. That is one of the symptoms of a bubble. When you start seeing these kind of easy things to make money, it's because the end is near. And what an end we had in 2008. Actually, I don't see. Maybe the only one that could start meaning something to hold, to receive interest, the dollar yen. That is again dollar yen, why it's a no-brainer. But at some point that will be exhausted and needs to be shifted. I mean, if you are paid 5% in the future of holding dollars and you have to pay almost zero for selling yen, well, it's like a free way to make money. So that means that something just got wrong, that something needs to be adjusted. So thanks, Karina, for letting me know that nobody's next. Here it says, yes, that's why we retail traders, we're just the small fishes trying to predict the needs from the big commercials. Yes, exactly. And we need to find a way just to find our, let's say, our time frame, where we actually perform correctly, because there are people that perform very good at very long-term views, and some others that are very scalping views, and if they try to go intraday or swing trade, they just lose money. You need to find where your brain and all your skills adapt the best. If it's maybe trading the 1 hour chart, let's put it that way, you need to start seeing, of course, to put a balance between the bigger ones that are watching the 4, the daily, the weekly, and the super small ones that not necessarily are retail traders. Because actually all the moves that you see in the markets, that move the markets, are not retail traders, are big institutions. So when you find that exact point, that you realize that your skills meet the challenges of generating money, that is the time frame that you need to start trading. Because you're just in the middle of a war between the huge super institutional investors and the super small aggressive retail speculators. It's finding where you feel more comfortable and of course more profitable. There are people, and this happened to me at some time, that I simply didn't feel at all comfortable trading. I started trading the daily charts, and I didn't feel comfortable doing that. But it was the only way at that moment that I actually generated my first income from Forex, trading the daily charts. So my trades lasted like 3 weeks, 4 weeks, 5, 6 weeks, and I really hated that. I really wanted to be in the active, in the action every time, trying to catch the swing of 10 pip, and that. But every time I did that, I lost money. So I just moved to the daily, because even if it was not what I wanted, it's where I worked, where my performance was correct. And from there, I started moving gradually to, well, pretty much any time scale, time frame that you put me now, I can trade it. But it's 11 years since I started. So yeah, it's a long journey, but you need to start where your reward comes, at least once at 2 months. Once every 2 months, you can actually withdraw some money out of your account. That would give you the sensation that you're actually doing it right. It's very hard to hold that you're progressing when you're losing money. Actually, you could be progressing, but you're actually continuing losing money, because you need to progress in such an amount, big amounts, to turn losses into break even. It's very difficult stuff, and as I said in other webinars, coming from the break-even to the profitable zone is even more difficult. It takes you 10 times the effort from coming from the losing zone to the break-even. It's 1/10 of the effort and skills that you need to develop to come from the break-even to the profitable. But well, you need to start in a point that you're making yourself a favor, and the only way to make yourself a favor is to at least have psychological peace of mind that at least you're trading the time frame that you actually, for some reason, are much more well prepared to trade. Here it says, RacerX, I like to think of myself as fisherman with smaller, faster, more maneuverable boats. Yes, and that is what in crisis, huge institutions lose a lot of money, and is where the retail traders can win tons of money because of that. Because you can actually open trades, very small trades. Well, I'm talking, you can actually open a 200 million position with pretty much not moving the market that much, and in huge movements like in crisis, you can generate tons of money. Of course, the big institutions that hold billions in positions, they cannot simply close and open and get out of the market in a click. So it has its advantages. Becoming a small, having a small boat, a small fisherman, allows you to adapt. It's like if a meteorite crashes the Earth. The ones that are smaller that could hide inside the soil were the ones that survived when dinosaurs extincted. Now we are the evolution of those animals, because they were small enough to hide in a very small margin of error and a small opportunity window to survive. And maybe the only opportunity window to survive at those moments were to live inside the earth, just to come outside, just to grab a bite of something, to find some food, and then you go inside again to survive. So yeah, Lehman Brothers knows that right, because they got into a lot of junk investments that at some moment they simply couldn't get rid of. And they are extinct after more than 100 years of existing. And a lot of retail traders lost a lot of money. But a lot of retail traders made a lot of money if they knew how to adapt to these movements. So it has its advantages. That is why I like to be, it is said that smaller is quicker, bigger is slower. It's relative, but yeah, at times it plays that way. FX Florida is true, just don't expose yourself at the big waves, Rex or X. Yes, going against a tsunami with my little boat, it wouldn't be a good idea. Day trading belongs to the institutional. I've tried that, being able to earn some bucks, but again, more on HTFs. What is that, FX Florida is? With less spend time. High time frames, okay. With less spend time, so swing trading for me forever. Or we're lucky enough to be crocodile. Okay, yeah, it depends. I can tell you, I love that at this point in my life, I am able to enjoy the bigger movements, to watch the bigger time frames like the ones I've been explaining in dollar yen, and translate them into applicable things in smaller time frames, including the tick charts. If I can be honest, I thought at some moment that that was impossible to be done. And the latest 11 years I've dedicated this, and at the end it helped me to get to that point. But it's not necessary. The thing is that you master something. For example, if FX Florida, if he is good at swing trading, stay there. Milk the market that way. When you start feeling, seeing, or having interest into moving higher or lower time frames, you can have a dummy account. And maybe at some moment you will get better at scalping Also, who knows? But it depends on the interest, because there are people that simply, for example, me, I didn't like having open positions for days and weeks, but for some reason I had the temper to hold onto big drawdowns because of my positions were not in the exact very best price, entry price, but I knew they were in the correct direction. So some people simply cannot hold that. They simply cannot hold a more than 15 pip drawdown, for example. So for them, this kind of trading is simply suicide. So the first is to find your time frame that naturally you're much more comfortable with. And then if you have interest, you can move from one to another, or complement one time frame to another, etc. Here now, the Forex market's just so much more complete than when I started, that you can have a lot of fun. For example, playing binary options or vanilla options with swing trading, you can make a lot of good ideas. You really don't need to migrate from one bigger to smaller time frame. In my ages, when I started, that was not precisely the day-to-day thing. So if you really wanted to know that you had the skills to adapt to volatile times, you needed to know that at least you needed to develop some skills in the lower time frames. But now, yes, I have the option of using options and then moving to smaller and bigger time frames, etc. So, but well, that is not. That's like a dream came true for me. But of course, it's not necessary to live that dream to profit from the Forex market. You need to find what fits you, what is in nature with your reality, because I had of course, I had the opportunity to dedicate 11 years of my life because I have no family. I don't have kids, I don't have wife. But of course, if I had 4 kids, wife, a loan, a mortgage, of course, dedicating 11 years to do this, it would have not, I would have done it, but of course it would have been very different. And maybe this would have become only an alternative extra source of income, not my main source of income. But well, it depends on everyone's situation. Here it says, and to close the webinar, some comments. By the way, I would like to thank again David Racerex for interaction, and FX Lord Ice, thanks a lot. It gives a complete different dimension. When I find somebody interacting, so nice. Here it says, I do that as well, lower time frames for a smoother entry and or small stop losses when my target and trade directions all come from higher time frames. I believe that is the smartest way to trade, because yes, it's logical. As you put it, it's logical. You go to smaller time frames to reduce your risk, but actually when you translate that into using take profit targets of higher time frames, that automatically should put you in a more than one-to-one risk reward. So that is desirable. I don't use that approach, but that automatically will put you in a 25 stop loss towards a 100 pips take profit. So if you master that, of course, that's awesome. You automatically use, I usually don't do that. I try to put a one-to-one in the same, in the time frame that I find much more attractive to me. I try to put a one-to-one and then I start moving it. But I start one-to-one. I have the overall idea of what's happening in higher time frames, but I don't tend to use those take profit unless my trade survives for some days. Then I look at higher time frames to maybe see, okay, I already closed 2/3 of my initial position, and the other is at break even, and this is open take profit. Where I can put this that is realistically possible, then I go to higher time frames. But this is the way I adapt it. Of course, everyone is different, but yeah, this is style. And you know what? I started trying to do that. it never worked for me. I was always stuck out in a loss. When I moved to try to, okay, I will focus on one time frame, use the one-to-one approach, and then I move it if days after or hours after the trade is profitable, then my results changed. For some reason, my brain was brained to do that. I am way more profitable doing that. So that is the way trading is so subjective and personal. And this is one of the best examples. FX Florida uses the higher time frames to take profit and smaller to choose stop losses. If I do that, well, I don't know if I do that now, but when I did that, I always lost money. When I decided to move my one-to-one risk reward when in a time frame that criteria meets, it's when, for some reason, I don't know why yet, my results changed. I started being able to close 2/3, 1/3 of my positions at the first acceptable take profit targets, and then the remaining to put them in a higher time frame take profit. But otherwise, I would be still maybe losing money. Here it says, FX Lord, I shift stop loss in profit, lock in position. In the worst case scenario, break even for high time frames trading and long-term positions. Hey, welcome, good morning. Thank God it's Friday. Yes, I need this Friday so much. Hey, my friends, all good? Yeah, all good so far. Welcome. And you, how are you doing? I'm waking up, breakfast, getting ready, doing some charts. Nice. Thanks, nice to see you. Guest 49, hola, ¿cómo estás? ¿De dónde nos visitas, Guest 49? Thanks, iiivb. It was a pleasure watching your webinars. Enjoy it. No longer. My strategy, try to lose as much money as possible and then win. It's no joke. So, well, that's an interesting approach. So you try to lose as much money as possible and then win as much money as possible, you mean? Yes, FX lower dice. Yes, shifting stop losses can change your strategy, results data, but good money management, you'll get minor losses, minor profits, and big profit trades. Yes. Money management is a complete different thing that if trading was not hard enough, then you have to develop your very own personal fingerprinted money management that fits your exact statistical data. Because your money management, for example, the one that FX Lower Dice has, the statistical data, and mine, if I try to apply his money management to mine, the most likely thing is that I will end up losing money. The same in the inverse. If he tries to adapt my money management into his statistical data, it's really a disaster. You need to really have a data set of, let's say, 1,000 real trades, live trades, at least at break even. And then you will start figuring out your money management, because money management is not risking only 1% of your account. That is not money management. I mean, money management, believing is like believing that you know, I don't know, chemistry just because you know the definition of chemistry. No, money management is so complex that it is said that an average break-even strategy, when you learn it, I mean, a flat trading strategy that always ends in break-even, you can become a multi-millionaire strategy when you really apply money management to it. When you really know the statistics, when you really know how that system behaves. And the only way to know it is when you are the creator of that system. So money management by itself could turn your break-even already a strategy into a winner one. But it's very difficult. because you have to use psychological things to understand you as a trader honestly and objectively. It's very complex. Here it says, Wilco, you have to do what suits you, I think. Yes, exactly. I agree with you, Wilco. Exactly that. What you feel comfortable with and is profitable. Yes. Not just because one dream to be the super scalper means that that is your time frame. So yeah, you need to look, like I just explained that when I started having the first real results in Forex was trading the daily charts. And I didn't like that because I wanted to trade the 5 minute, the 1 minute. But well, I needed to say, okay, I could still lose money or just maybe try to settle with it and try to move forward from there. And I believe that is the smartest way to do it. Be honest with you. If you are profitable in the weekly, trade weekly. So what? You don't have judges here putting you a 9, an 8, and 10. You're not fighting for the gold medal. Here's a marathon that you need to survive for. The longer you survive trading, the more chances you have to actually make it. Lord, it's true. That's why paper trading is important. I always said you need 6 months at least on demo to gather enough data for your next strategy changes for the real accounts. Well, yeah, I've explained in some webinars that I believe that demo accounts are first for the super beginners, but then it's necessary that you lose real money, because you can have a super perfect demo paper trading strategy that when it comes to emotions of losing and winning money, you destroy the statistical data that you gather. But well, that's my approach. Of course, maybe there are people that could learn from demo and apply it into live, like if it was a demo account. But in my case, I couldn't do it. I needed to lose money to learn how to master or to domesticate my emotions towards winning overall. FX Lord Eyes, I was a long distance runner in my youth. Usually this is happening because beginners, after having big profits on demo, change their strategy on the real accounts. Well, yeah, I can tell you about myself, not about others. What I realized in my case, and I talked about in some other webinars about this, so the psychology of trading, is that the triggers of the rewards of having real profits or real losses completely switches everything. It's like those emotions, those hormones, those things that are triggered, it's like putting you glasses, dirty glasses, and you cannot see accurately what is happening. Maybe the strategy you feel is the same, and you are doing it the same. The thing that is changing is that the information you're receiving is distorted because of those hormones. Those, for example, adrenaline. Let's put it that way. Adrenaline changes. It's like love. And when you are in love, you tend to see things differently. Starting with your partner. And starting your partner with you. They can see you the most handsome guy in the world when maybe you're average, but she's in love. So that is more or less what, at least in my case, happened. And when I have the chance to give my insights to people, is yes, start with demo because you need to master a lot of things like what is a stop loss. It will get to a point that you actually need to start paying for your education. This is not free education. If you can afford losing $100 every 2 months, do it. But do it. Guarantee yourself that $100 will last 2 months. But do it. Because the moment you start winning, you will start feeling that this comes natural to you, and you will start overlooking a lot of things. And that will end up destroying the way you trade. Because you are like drunk. It's like the inevitable thing that happens when you start drinking beer. After 5 beers, The most likely thing is that you're already drunk, or at least me, I don't know, other people. So it's to learn how to drink is when you need to stop drinking to maybe drink just one every 3 hours or 4 hours, etc. It's a very personal thing. That is what I believe. But of course, if there are people outside that they can actually play the demo and the live accounts exactly the same way, my respects, because I never could. And so far, I sometimes I apply, and you can see that the contest accounts. These last 2 months, I've destroyed 2 accounts. When in January, I had like 600% in profit. So something happens when for example, the demo accounts, I use them maybe to try different things. But I know that once they, those things I feel comfortable with demonstrate me that they have a future, that they are promising, I need to start adapting those to live accounts. Because at some point the emotions are playing jokes at me, or bad jokes at times. But well, that's my idea. Here it says, usually this is, okay, FX Forward Eyes. I hear you, that's why I have some demo exercise for beginners that use a conflict for the entry plus a good money management. Yeah, that's a very, very good one. Because then they realize the power of money management. The power of money management could save you from bankruptcy, even if you have a coin flip deciding your direction. That's a very good one, FX Lord Eyes. I didn't know that you have I don't know, what you have, an academy? You can basically blow your account away even if you have random entry coin flip. This remove emotions for entry and understand patterns of money management. Yes, I completely agree with you. And with that, guys, on goals, I finished this webinar. 1 hour and, if I'm not wrong, 20 minutes. And yeah, every time I say the same thing, that maybe I won't make it to the hour, it's the one that I end up having an hour and a half webinars. So, okay. I would like to thank everybody for being around. Wilco, thanks for showing up. All the guests. RacerX, David, my friend, thanks a lot for being around again, for your feedback. Thanks a lot. That means a lot to me. FX Lord Ice, thanks a lot for being around too, and the feedback has been great. And remember that I expect you on Monday, because this is Friday. On Monday, same time, same place. And Katarina laughs about that when I say it's going to be a short webinar. It's the longest ever. Thanks, iiivb. Take care, and green pips only. Yes. Likewise, FX Lord Eyes. RacerX, David, thanks, man, to you too, and happy weekend to you all. Katarina, thanks a lot for hosting, for recording, and see you all on Monday. Before leaving, this is my social networks so far. YouTube channel, type it, subscribe. Google Plus, look for me and follow me or bookmark it. This is me, Alberto Alvarado. I would like to thank everybody. Remember to have a wonderful weekend. I expect you Monday, same time, same place. Trade safe, be safe, and bye-bye.